Hi, everyone. My name is Alexis Long. I'm the Director of Wealth Management at Willis Johnson and Associates, and I'm here today to talk to you about how inflation, interest rates, and segment rates are going to affect your Chevron retirement plan pension calculations. So, a little background on how the Chevron pension is calculated. Chevron pension is a qualified pension plan for Chevron retirees. The plan accumulates value for an employee over their tenure at Chevron. A formula factors in three variables, three, to calculate an annuity benefit. Here's the formula on the screen here. It's 1.6% times your years of service times your average final compensation. An average final compensation is your compensation over your 36 most highly compensated consecutive months over the last 10 years. So often at the end of a career, compensation is a little bit higher. So staying a little bit longer can add benefit to your pension values. So that just gives you a little bit of background into how the benefit is calculated. On the Chevron pension plan on the CRP, there are two options available for the pension. There's the lump sum option and there's the annuity option. And we just talked about how the annuity is calculated, 1.6% times years of service times average final compensation. But how is the lump sum pension calculated? Well, that is calculated by discounting the annuity benefit that you get through the formula by segment rates, which are published by the IRS every month, and they're based on where interest rates are today. So there's the key. That's how inflation and interest rates are going to impact your lump sum pension calculation. So let's talk in a little bit more detail about how segment rates can affect a lump sum pension calculation. So first, Chevron does a 3-month look back to determine which segment rates they're going to use for the lump sum calculation to discount that annuity stream. I have two examples of calculations here on the screen. So let's assume you have a Chevron retiree that is considering retiring in February, or was considering retiring in February of this year, or is considering retiring in May of this year and immediately starting the pension. Assuming the assumptions are the same for the annuity benefit calculation, the segment rates have actually gone down slightly from the February start date to a May start date. So you can actually see that using the same assumptions, the lump sum value went from 1.94 million to 2.02 million. And that is an increase of over $74,000 in the lump sum pension just to wait 3 months to start to take the lump sum out of the pension plan. That's just in 3 months. So just waiting and seeing where interest rates go, and if they go down slightly, can have a major impact on your pension lump sum calculation. So here's an additional example of what if a Chevron retiree had decided to retire and start their pension last year in May versus waiting another year and retiring this year in May and starting their pension. So in some people's minds, it makes sense to stay a year longer because you're adding another year to the annuity calculation. You're also adding additional years of compensation, which I mentioned earlier. Typically, your last several years are your most highly compensated years. But what's happened over this last year is that inflation took place last year. We went into a high inflationary environment. And so the Fed started raising interest rates last year to combat inflation, which caused segment rates to increase. And they increased dramatically between May 2022 and May 2023. You can see how much they went up here in these examples. So if we use the same assumptions that we used in our previous example for a Chevron retiree, here is the difference between those pension calculations. If someone had taken the pension last year in May versus this year in May. So drastic difference in segment rates means a massive decrease in the value of the lump sum pension. The pension value went from 2.4 million to just over 2 million. That's a $423,000 decrease. Huge decrease that you're unlikely to make up through salary, SIP, or any type of stock compensation. So it would have made sense to leave a little bit earlier, or it may make sense to wait a little bit longer and see where rates go from here. But retiring this year in May and starting that pension, you've lost a lot of money because of the increase in segment rates. So, something to keep in mind as you are approaching retirement and thinking about your lump sum pension calculation, especially because we do think that interest rates may not come down for a while. So here's where inflation has been going back to the 1970s. We have not been in as high of an inflationary environment as we were in 2022 since really going back to the 80s, the early 80s. So almost 40 years, we have not seen inflation this high. We were up over 9% last year. Now we've come down to about 4.5% on inflation, but that is still not close enough to the 2% target that the Fed wants to be at. So there's a possibility the Fed raises rates again in June, or may raise rates again over the summer. They may not. We may stay where we're at today, but it may take a while for rates to start coming down. So something to keep in mind as you're considering your options for the Chevron pension, especially if you're considering the lump sum. Where will rates go from here? We don't know, but may make sense to wait on that pension lump sum over the next few months. If you want to learn more about maximizing your benefits, we do have a free webinar on timing your Chevron retirement. Click the link below to find that. There's also a QR code here where you can find me on LinkedIn, or you can follow Willis Johnson and Associates on LinkedIn or Facebook. You can also subscribe to our YouTube channel for additional content. Thank you so much for joining me today, and I hope to see you later.